A warm good evening to all the participants. Before understanding how to tide the uncertain times, we need to understand why the times are uncertain currently on global and national fronts. On the global front, Federal Reserve is going to raise interest rates at least 6 times in 2022, and Fed balance sheet will shrink by 1.15 trillion USD, which will result in reduced liquidity as inflation is at 40-year high in the US. Bond yields are increasing and inching towards 2.75 to 3% in the US, 6.75% to 7% in India, which will have a telling effect on the equities. Brent has touched 137 USD and cooled off to 100, and still it is above the comfort levels. And the FIIs are relentless sellers of Indian equities. Even yesterday, they sold about 5,000 crores of Indian equities. Over 15 billion they have exited year to date. How to overcome this wall of worry? We have Mr. Mehul Jani from IIFL is joining us to explain how to tide through the uncertain times. Let me introduce Mr. Mehul Jani, who is the Senior Vice President for Listed Equity, and he is a CFA charter holder. And before joining IIFL, he has worked for large organizations like DSP BlackRock and Morgan Stanley, with a combined experience of over 17 years. IIFL is the one of the best performing PMS strategies with a return of 19.70% since inception. I would like to thank our strategic partner Paytm and Paytm customers who have joined this webinar. I hand over the stage to Mehul Jani now to present a strategy. Then we will have a Q&A. So to you, Mr. Mehul.
Good evening, everyone, and thank you for joining us today. Thanks to Paytm Money and PMS Bazaar for organizing this. I hope you can see my screen.
Very well, very well.
So just as an agenda, the way I've structured the discussion today is I'm going to start off with an introduction to the IIFL Asset Management unit, the team and the process that we follow. After that, I'm going to talk about a couple of large sectors, that we are quite positive on, and how to think about the top-down long-term opportunities there. And post that, just take you through our investment philosophy and how we look for bottom-up ideas within the sectors that we're positive on. So to begin with, just as an introduction, IIFL AMC is a 100% subsidiary of IIFL Wealth Management. IIFL Wealth is one of India's largest wealth management firms, and with a combined AUM of $35 billion. In the AMC, we have 4 books of business. So we have a private equity book of business, which is about $3 billion, roughly about 23,000 crores. And we have various funds there. So we have very early stage, seed stage funds as well. And more popularly, we are known for our pre-IPO and late stage consumer tech fund, which was launched more recently. On the public equity side, we run 3 main strategies. So we have diversified funds, which includes our multi-cap PMS, which we shall be talking about today, along with our mutual fund. We also run concentrated AIFs. So we have a couple of concentrated AIFs, which are 15 to 20 stock portfolios, which are slightly higher risk, higher return. We also have a third core strategy, which is our thematic on financial services. So we run a segregated account for one of the US universities, which is solely focused on financial services as a theme long term. Apart from this, we also have a structured credit business, and we have a Pan-Asia multi-asset fund, which is run out of Singapore. Just as a team structure, Anup Maheshwari is the CIO of IIFL AMC. In the fund management team, there's myself, and we have 3 other gentlemen part of the fund management unit. We operate almost like an investment committee sort of approach. So even though we might be named as separate fund managers on separate funds, we are very collaborative and work together and make sure that every idea that comes through gets properly reflected in the appropriate funds. We're ably supported by a strong research team. So we have 6 research analysts, and we're looking to add a couple of more also into the team. These are organized by sectors. So each analyst will be covering at least 1 or 2 sectors. I'll skip over this. Maybe we can come back to this later on. So this is interesting because, the question that you asked earlier in terms of, how do you navigate the volatility that we're seeing and the uncertainty that's present in the markets today and in global markets as well as India. And it's important at these times to not forget the long-term opportunity that's available, right? So we've got a couple of slides here just to talk about, some of the long-term potential that we see. So this is a slide about the consumer lending business. There's a lot of numbers here, but I'll try and simplify it. So if you start with the left-hand side of the screen, India's GDP overall is about $2.8 trillion. So 200 lakh crores roughly is where India's GDP is. If you take all system credit, so this is all lending by financial institutions in India. This includes banks, NBFCs, housing finance companies, everyone put together. That's about $1.7 trillion. So roughly 60% credit to GDP ratio. That's where we are. That number in itself is a low number, right? So most developed markets are much higher than that. So like the US will be 150% of GDP lending to GDP. Even emerging markets are usually higher. So that number itself has room to grow. But even when you dig deeper into that, so the corporate and SME side of things is about 67% of this number. And you look at retail credit to GDP, which is lending to people like us, right? So giving home loans, auto loans, microfinance, absolute, granular loaning products is about 33% of this 1.7 trillion. So about $560 billion. So when you look at this 560 billion on a base of 2.8, let's say 3 trillion rounded up, it's about 17-18% of GDP. Again, this number is definitely one of the lowest in the world. So 17-18% retail credit to GDP would, compare to emerging market average of what between 30 to 50%, and most developed markets will be 70 to 100% in terms of retail credit to GDP penetration. So there's clearly room to grow. But again, these headline numbers in India don't really tell you the true picture of what's going on. So we try to dig deeper within this number as well. So on the right-hand side, what we've done is try to split even this retail credit penetration. So when you look at the number of households in India, so we're about 28 crore households, 289 million on a 1.3 billion population with a per capita income of $2,000. Retail credit, as we said, 560 billion. But when you again try and dissect this into where is this credit today available? India 1, and again, this is BCG definitions. This is the top tier, let's say the urban tier 1 customers of India. There's about 36 million households. It's about 12% of India's households earn per capita income of more than $3,500. These are usually, in the metro cities, let's say the top 15 to 20 cities in India. India 2, which is, let's say the middle class India, which is about 59 million households. This is roughly 20% of India. And India 3 is 67% of India. So large percentage of India is India 3 with only $1,200 per capita income. This is almost, comparable to what African nations would be at. So these are clearly the more challenged part of India. And there is clearly an effort being made to drive up this population towards India 2 and India 1. These numbers, thankfully, are moving in the right direction. So India 3 as a population base is reducing, India 2 is growing, and India 1 clearly has been growing quite rapidly. When you look at where retail credit has penetrated today, it's not surprising that most of the credit is going to India 1. So 70% of this retail credit has been given to India 1. And when you think about it as well, most banks, NBFCs, etc., find it very easy to operate in metro cities. It's very easy to get a loan. If you're sitting in Bombay, you want a home loan, there'll be 10 companies who will land up at your doorstep to give you a loan. But as you go down into India 2 and India 3, the banks, NBFCs, even some of the smaller institutions have not managed to penetrate so far. So only 10% of credit goes to 70% almost of population, which is India 3. This is changing rapidly now. So the one big change that we've seen over the last 10 years has been the financialization of the economy, right? So with the Aadhaar program and the Jan Dhan accounts that got opened, India added almost 35 crore, 40 crore new banking accounts. Although these customers didn't have too much money to put into these accounts to begin with, but the government efforts to make sure that everything gets digitized. All subsidy payments are now going through bank accounts. With UPI now, most people are making payments through digital means and going from bank account to bank account. This has meant that, banks and institutions finally actually have data on these customers as well. So within India 2 and India 3, the data availability on these customers is only improving. And, with data, the credit worthiness can be assessed better. And therefore, you're seeing credit growth to India 2 and India 3 rapidly expand. And you're seeing that, right? So microfinance institutions, affordable housing, two-wheeler loans, all of these are growing much more rapidly over the last 5 or 6 years, apart from the disruptions that we've had due to COVID. And we believe this is a secular theme. So we believe retail credit can continue to grow more than 15% for the next decade, and we will still be an underleveraged economy on a household basis. And within that, obviously, there will be splits that will happen where maybe India 2 and India 3 grows faster. India 1 penetration is already quite high, so maybe it grows slightly slower. But the opportunity is very large for banking and financial institutions to provide credit. The other thing to note here is, when you think about India 1, right? So 36 million population, let's say there's 2 or 3 adults in every household. So about 70 to 80 million adult population. That's about 7 to 8 crores just in Indian terms. That number ties in very well with other consumption products as well. So when you think about the number of demat account holders, is roughly the same, right? About 70 million. You look at number of passport holders is again 70, 75 million. Number of tax filers, again the same number. You look at number of cars on the road today in India, total stock of cars ever sold is about 30 million. So it's roughly there's high penetration in India 1 clearly. India 2 and India 3 don't have these products. You look at mutual fund investors, you look at number of credit cards outstanding. So again, comes back to the 60, 70, 80 million sort of number. So it, again, when you look at these proxy indicators as well, it tells you that a lot of penetration still remains to India 2 and India 3 eventually. As companies reach further, they get more data, the disposable incomes of these customers rise, there is scope for this to grow. So this is one secular theme which we believe can generate a lot of shareholder value over the long run. And this is not just consumer lending, like I mentioned, this will apply to consumer discretionary, all consumption products as well. The other big sector is our IT services sector. And, when you think about the market as well, IT plus financial services is roughly 50% of the market. And it's 50% of India's wage bill as well. So when you look at the BSE 500, total salaries paid, which is about 123 billion, roughly 30% of that is just IT services. And this was 10% in 2002, is close to 30% now. And this is rapidly rising. As more and more businesses become IT enabled, there is this whole thrust towards cloud migration. You're actually seeing revenue growth accelerate quite meaningfully for the IT services companies. And which is why it's not surprising that the hiring has increased quite dramatically over the last few years. So the IT services sector is expected to hire 1.35 million people in the next 2 years. This is more than what they hired in the last 7 years combined. So clearly, there's very strong growth that's taking place in the IT services space as well. Again, this has knock-on effects for other sectors. The IT exports today is equal to our oil imports. In fact, it had exceeded before this oil price rise. But even with oil prices at close to $100, the IT exports are roughly equal to that. So, when people start worrying about our current account deficit, etc., the IT exports actually is offsetting a large part of that pain due to the oil price that we've experienced now. So $100 today in oil prices is very different from $100, let's say 7-8 years ago, when IT exports were a much smaller number. And therefore, we would not be too concerned about macro if you look at these numbers today. The other thing to remember is there's a huge multiplier effect as well. So for every job that's created in the IT sector, there are 4 jobs that are created in the rest of the economy. And clearly with IT hiring being very strong, that should mean there's a lot of jobs being created in other sectors as well. IT also means real estate will do well. So, and you're already seeing that Bangalore, Chennai, Hyderabad, property prices are rising as IT sector is booming. That this works for commercial real estate as well as residential. And the other great part about the IT sector is the women participation in the workforce, right? So IT sector actually is close to 40% in terms of women participation in the workforce. And this number is only rising over a period of time. So again, the message that I was trying to give here is, with these 2 sectors doing really well, it's roughly 50% of market cap for India, is roughly 50% of the wage bill for BSE 500 companies. You can't be too negative on the long-term opportunities that we have in India today. When you combine this with overall corporate profits to GDP, this is just again another slide showing the significant pain that we've gone through over the last 10 years, and this is almost a downward sloping chart over a decade, where corporate profits to GDP were just coming down. And we've seen the first sign of this improving back to averages in the last financial year. There were many reasons for this. The infrastructure sector took away and produced a lot of losses. The metal sector was struggling. Our financial services sector was struggling with loans given to infrastructure and power in the previous decade. A lot of that pain is now behind us, and you're seeing bank balance sheets being very strong. You're seeing even infrastructure companies, commodity producing companies deleverage quite meaningfully. When you look at Tata Steel, you look at Reliance, you look at Hindalco, a lot of look at the Adani group, they've all managed to deleverage their balance sheet quite meaningfully. And therefore, we seem to be in pretty good state in terms of corporate balance sheets. And that is coming through in terms of corporate profits as well, as we are seeing the economic upcycle come through. Now, how do you, this is all great, and top-down India definitely looks great, and most people will tell you that we are very positive in India long term. But how do you construct portfolios around it? And this is just our investment philosophy and framework as to how we construct portfolios. What we've done is we broke the entire market down into 4 quadrants. We call this our SCDV approach, where we had 2 key axes where we wanted to rank companies on. So one is profit growth, and the other is return on equity that our business produces. These are the 2 most important parameters that determine shareholder value creation in the long run for any company, right? So if you had to ever screen for companies, these are the 2 vectors you should be looking for. And the midpoint, the par value for us is 15%, because that's basically been the median return on equity for the Indian market, and that's been the median profit growth also for the Indian market. So 15% is, let's say, the midpoint of this. So any company that's delivering on the right-hand side of this chart is delivering more than 15% ROE. And anything on the top half of this chart is delivering more than 15% profit growth consistently over the last 10 years. So when we say consistently, we say 6 out of the last 10 years, the company should have produced more than 15% to qualify. And the top right of this chart are secular growth businesses, as we define them, which are companies that are able to deliver profit growth with high return on capital consistently over the last 10 years. And we've just named a few sectors here. Not every company within that sector will be part of the secular quadrant, but it's just showing where majority of the businesses come from. And again, it's not surprising if you look at the top-down approach that we spoke about earlier. A lot of the consumer discretionary, a lot of the financial services, retail, spaces show up here. Autos, they show up here because there is that growth potential that they can deliver over a period of time. So our approach is to be overweight this sector at all times in our portfolio. So the BSE 200, which is the benchmark that we use for most of our mandates, has 23% allocation to this quadrant. We aim to be overweight this. So today, if you look through our portfolios, depending on the product that we are talking about, will be between 35 to 40% in this quadrant. The exact opposite of this are what we call value traps. These are companies that don't manage to deliver profit growth or ROE on a consistent basis. And again, it's not very surprising, but a lot of the regulated businesses, a lot of the commodity type businesses will show up here. This is not to say that they can't go through a growth curve for a short period of time, but over a 10-year period, usually it is the case that they will not be consistent. And our aim is to be as underweight as possible relative to the benchmark in this quadrant. The other diagonals are cyclicals and defensives. So cyclicals are businesses that can go through high growth periods in terms of profit, but because these are usually more capital intensive businesses, their return on equity profiles are not very consistent, and therefore, they'll be on the left-hand side of this chart, delivering less than 15% ROE. And the other opposite of this are capital light businesses. Businesses like consumer staples, healthcare, IT services, media, which don't require too much capital to grow. These tend to be more mature businesses, and therefore the profit growth is less. But the way we approach the cyclicals and defensives is you need to be slightly contrarian in your approach, right? So you want to own cyclicals when valuations are down, economy is bottoming out, growth has just started improving. That's when you make maximum return by being overweight cyclicals. And the other side is when market starts overheating, valuations have run up significantly, cyclicals have become very expensive. There's clear signs that the economy is starting to slow down. That's when you want to start tilting your portfolio towards defensive. So you need to be slightly more contrarian, slightly more tactical with your cyclical and defensive allocation, and that's how we approach it. So just to summarize, we'll always be overweight secular, we'll be underweight value traps, and between cyclicals and defensives, we try and be a bit more tactical. And this is just a back test of returns on these quadrants over a period of time. What you'll notice is clearly there's a lot more green in the secular quadrant and a lot more red in the value traps quadrant. And between cyclicals and defensives, it can be quite volatile. And this is just to show that obviously, even on a backtested basis, the returns do match what we're talking about. The other thing, and this question gets asked a lot and is very important, is no company or no industry remains in the same quadrant forever, right? Businesses also go through their own life cycles. So if you ran a secular quadrant in 2010, a lot of the infrastructure businesses, real estate companies, all of those showed up as secular growth. And we know what happened after that in the next decade. So it's also important to keep monitoring companies. If people sometimes say, okay, now I know what the secular quadrant is. I know whether a company is secular, defensive, cyclical. I will just make my allocation and forget about it for the next 10 years. If that was the case, we'd be out of jobs. But it's important to keep, monitoring companies, monitoring industries, focusing on where changes are taking place. So again, a lot of numbers on this chart, but the only message here is there were 96 companies that were secular in 2010 in the original classification in 2010. Out of those, only 11 remained secular. The remaining moved to other quadrants, and 43 out of the 96 actually became value traps, right? So, if you just held on to those companies, you wouldn't have done very well over a period of time. You need to make sure that your company is not slipping off into other quadrants. And similarly, there can be upward migrations as well, right? So it's something that started off as a value trap could migrate into a secular and cyclical quadrant as well. So it's important to focus on these migrations because again, you can make a lot of return when a company is shifting from due to industry consolidation or a business restructuring, the return on equity profile is changing for a business. That's when you make the maximum return. So just this is just our portfolio as it stands today. I'll leave that for later. And in terms of our performance, I think Sivaram mentioned it earlier. So we've had good alpha creation since our inception on our PMS strategy and across our other strategies as well, which is our concentrated strategy, which I referred to earlier. I'll just preempt one question now and just go through another piece on valuations and what kind of returns one should expect over a period of time, and how to think about the duration of your investment. So this is just a chart showing the median returns of the stock market, which is the blue line. So at every point over the last 32 years, so since 1990 to 2022, if you took any 1 year period, so all the 1 year periods and the average of that, similarly, all the 2 year periods, all the 3 year periods, all the 5, 7, 10 year periods, what you will see is the blue line is quite flat. So doesn't matter how long you invest for, your median return outcome has been a fairly narrow band, right? So between, let's say, 10 to 14% or so. That's the average return. And therefore, this is not surprising why most managers or more wealth advisors will tell you you should expect 10 to 15% return from your equity investments. The problem with that is the standard deviation of those returns, right? So the way to think about standard deviation is how certain can you be that you'll get that return if you invest today. So on a 1 year basis, the standard deviation is 35%, which basically means there is a high degree of uncertainty of you ever getting that 14% return. You can't ever be sure. So if anyone tells you over the next 1 year what return you're going to get, the standard deviation of returns is so high that you should never believe what someone tells you. But as duration increases, as you go to a 5, 7 year period, the standard deviation of those returns falls, which basically means you can be more confident of getting those returns from the market. And again, this is over a 32 year period, all the daily, at any point of time had you invested. So it's a pretty long period of time. I think the message here is invest for at least 5 years. And then you should be able to get this 10 to 15% return that everyone keeps referring to and be more confident about those sort of returns. And this is a Sensex. Hopefully, as fund managers, we'll generate alpha on top of that and you'll get slightly better returns from us. And just concluding slide on valuations. So if you just look at, and again, this is our preferred metric, which is the price to book ratio for the Sensex. The normal band is between roughly 2 times to 4 times book is the normal band of the Sensex price to book ratio. It does stretch in some phases lower as well as higher, but roughly 2 to 4 times book is where it spends 85% of the time. So 50 plus 34. And we're roughly within that, we're slightly at the top end, but we're within that range, within the normal range. And therefore, again, I wouldn't be too worried about headline valuations right now. If the market spends some time consolidating around current levels, this ratio will automatically adjust down as, this is based on a forward price to book as well. And therefore, I would not be too worried about headline valuations. I think bottom-up stock picking becomes essential to generate the alpha that we're talking about. So I'll just stop here, Sivaram, and maybe we can take Q&A now.
Sure. Well, and in fact, my biggest learning, it will be for the investors also, the standard deviation and the equity return chart is very interesting. And in fact, you invest for long term is the first lesson. The investors need to have at least about 5 years for an investment to mature. And the second biggest lesson we got is how the stocks move from one column to another column, and that was another lesson. So be with an active manager is another lesson we got. Let us get into the questions now. Okay, on the corporate the systems credit present in the presentation, you told 33% and 560 billion is from retail. That is moving well, while the corporate credit is not growing as much as the worry. Do you concur with this, and what is your outlook as unsecured credit goes up is what the worry is an investor responds to?
Yeah, so two parts to that question. So it's a correct observation that corporate credit has not been growing the last few years, and it ties in well with the fact that corporates were deleveraging, right? So a lot of corporate India balance sheets were over leveraged in the 2008, 9, 10 infrastructure boom. You know, whether it was power sector, roads, mining, etc., metals. They over invested for a period of time, and due to various reasons, the debt to EBITDA ratios actually spun out of control. We saw a lot of bankruptcies as well. So what we've been seeing over the last few years has been deleveraging. So a lot of companies have been using their cash flows to repay their debt and bring down their debt equity ratios. I think we're at the fag end of that. So even a company like Reliance repaid a large portion of their debt, which they had taken to invest into Geo. But we are starting to see some early signs of CapEx coming back, right? So people are investing in data centers, people are investing in renewable energy. So there's some new areas of growth now. We're seeing some CapEx coming back in the cement sector as well. So there is some element of CapEx coming back. But I agree with the observation from the question, which is corporate credit growth has lagged in the last few years, and it will probably take some time before it starts inching up again. The one good thing about inflation, though, is as inflation starts moving up, working capital requirements do increase for most corporates, and that will also drive some credit growth for the corporate sector. I think the other part of the question was, our comfort with unsecured credit rising.
Yes.
I think, again, if you just go back to that India 1, 2, 3 breakup, what you will also realize is a large part of retail credit, I think more than 50% of retail credit today is home loans. So that's the first product that goes out to most people, most individuals, right? So India as a culture is very credit averse traditionally, right? In our culture, taking on debt and consuming is traditionally viewed as a bad thing, which is slowly changing now. So you're seeing, higher penetration of other products coming through as well. So housing loan was still okay, but, using a credit card or taking a personal loan or taking unsecured credit in any other form was previously not, let's say, acceptable behavior. But I think with our young population and, habits changing, you'll see a lot more utilization of unsecured credit, whether it's credit cards, whether it's buy now, pay later schemes, etc. They will only rise. It could become a concern if people start over leveraging themselves. But for now, I think we're starting off from such a low base that I wouldn't be so worried right now. I think Indian households are quite underlevered. Again, relative to other markets, we're extremely underleveraged as households. And therefore, I would not be worried at this point. It could become a concern, let's say a decade later from now. But for now, I think we're okay.
That's well explained. And the next question is, the financials and IT combined covers about 50% of the index. And IT generally as a sector has done very well. But relentless selling by FIs on the bank side, the large bank sides, have prevented the banks from performing for the last few quarters. And what is your outlook on this widely held large banks, and will FIs will come back?
Yeah. So again, correct observation, absolutely right. And the IT sector has actually done really well, outperformed most other sectors quite handsomely. The financial sector, I think, in the end, it's a reflection of macro views being taken by foreign investors. What tends to happen is the largest and most liquid sector that's available. It's also the most overowned sector by foreigners. So if you look at foreign ownership across banks and NBFCs is very high. So, you can only sell what you own. So when they're looking to take money out from emerging markets due to various concerns globally, due to, concerns around Fed raising rates or, let's say this emerging market issue that's happening because of Russia, Ukraine, etc. The first sector that gets sold down is the financial services sector. So I don't think it's a true reflection of the underlying fundamentals of the businesses. Some of the selling is quite agnostic of what's happening fundamentally. It is just a call on, sell India and therefore sell whatever you own and get out. I think clearly balance sheets for all banks, and this includes PSU banks, have improved materially. This is one of the first years where there was no budgetary allocation towards PSU bank decapitalization. That itself sends, a strong message that you clearly are out of the woods, and the PSU banks are able to generate capital for themselves. And as growth starts picking up, and we're seeing early signs of that in the the Q4 previews that have come out from some of the banks, I think the stocks will do quite well. Valuations are quite reasonable. They're at or below long-term averages. ROEs are improving over the next couple of years. They've already improved and probably set to improve further. And I think the only missing piece has been growth, which got disrupted due to COVID. We're probably seeing the first signs of the opening up of the economy having an impact on growth also picking up now. So I would be quite optimistic on the financial services sector. Again, you need to be stock specific and selective. But broadly, I think the large cap banks look quite strong right now.
You classified PSU Bank as a value trap. 7-8% credit growth now for India. Most of it are garnered by the private banks, and the other side of it, the argument is the domestic institutions are buying. And which is offsetting the foreigners going out. Do you think the domestic flows are there to stay for long term?
Yeah, I think again, two parts to that question. On the PSU banks being classified as value traps, this is just an objective classification. So based on their track record for the last 10 years, they qualify as value traps because they've not managed to generate ROE or profit growth consistently. SBI has been the only one which has generated some shareholder value. All the others have not managed to deliver any significant returns. But again, I think there are signs that things are improving. And again, if you see the migration that we spoke about earlier, they might not remain as value traps forever, right? As balance sheets have now improved, their growth is improving. And if ROEs start exceeding, they could deliver 15% ROE. Over the next couple of years, if things don't derail again, there's no further COVID waves, etc. I think some of the PSU banks, maybe not all, do have ability to come out of the value trap quadrant as well. I think the other question you had was, sorry, I missed. I forgot what the second part was.
Now the foreigners selling is offset by DIA buying and individual buying, and will it be a secular thing in the future is what I wanted to ask.
Yeah, so I think that again ties in with that India 1, 2, 3 discussion that we had, right? So maybe it's not as secular, you might not get growth every year, but again, if you take a 10-year view, our penetration of people investing into the stock market, if you look at the number of demat accounts, you look at number of mutual fund folio holders, unique mutual fund folio holders, these are still between 3 to 5% of population which are investing into Indian stock markets today. Most of our population has no idea what the stock market is, unfortunately. None of us have managed to reach out to the masses and educate them. And I think this is, over a period of time, as incomes grow, as the education levels rise, as interest rates remain low, right? So as fixed deposit rates remain low, other avenues of savings are not generating enough returns. I think equity investment will become more and more popular, and this will be a secular theme, I think, over the next decade.
This is related to banks again. RBI has come out with a accommodative policy today. 11th consecutive time they have made the policy accommodated and they have not changed rates. But do you think it is imperative that RBI has to raise rates in the near future?
So RBI is in a bit of a tight spot, I would say. A lot of the inflation that we're seeing is due to supply side disruptions that are happening globally, whether it was in China earlier, or whether it's with oil prices now, with what's happening in Russia, Ukraine. Thankfully for us, food inflation still remains relatively controlled in India, but there will be a feed-through impact of oil prices, diesel prices, let's say fertilizer prices also inching up. That will feed through into food inflation also eventually. So RBI is in a bit of a tough situation right now, but I think they're taking the right approach. I think we're in a nascent recovery in terms of our economic growth is just starting to improve after 2 years of COVID disruptions. I think it's too early to start tightening very aggressively unless things start spiraling out of control, and things are still extremely fluid, right? So, oil prices hit $130 at the peak of the Russia-Ukraine conflict. They've corrected down to almost $100 as we speak. And it's moving 5 to 10% every day almost. And it's difficult for a central banker to take a strong view in either direction right now. I think if oil prices do manage to finally settle between 90 to 100, I think we're in a decent position. And like I mentioned, our IT services exports offsets the oil import bill that we have. And I wouldn't have too much worries on the macroeconomic front. Inflation might still remain slightly elevated and we might hit, let's say, 6%. But again, relative to what we've seen in the past in our economy, double-digit inflation, etc., not too long ago, I think we've forgotten, our economy can handle 6% inflation quite well and 7-8% interest rates. I think a little bit of inflation is tolerable, and I don't think things are spiraling out of control. So I think RBI is probably making the right move. It's more of a wait and watch. They don't want to be too early to start tightening in a recovery sort of economy right now.
Perhaps you have preempted the question, and my next question was on the CPI inflation at 5.7. It is tolerable, and certain tolerable inflation is good for equities, is what you are saying. The
Absolutely.
Next question is the corporate earnings outlook, and it is going to be good this year and next year. What is your outlook for next 2-3 years as inflation catches up and the supply side shocks are still to be overcome? What is your outlook on the corporate earnings?
Yeah, so I referred to this earlier as well. So corporate profits to GDP, the ratio has risen quite meaningfully as some of the losses and loss-making sectors have actually turned profitable. So whether you look at telecom, whether you look at some of the metal companies, a lot of the oil and gas sort of businesses, those have turned profitable, and some of those were making losses until a few years ago. The other big sector in terms of earnings, we mentioned IT services earlier. Our pharma companies are also doing quite well. The US price deflation, price erosion that was taking place has slowed down to some extent. Indian pharma market is doing quite well. So pharma sector is doing and should grow quite well over the next few years. Our auto sector, again, a big employment generator, a lot of knock-on effects on other sectors as well. Auto sector has been struggling for a few years now, and it's been through one crisis after the other with liquidity drying up post RNFS. We had then the COVID-led disruptions, where the insurance costs going up. You have the EV-led disruption now, which is more to do with two-wheelers. But I think auto also looks like we've bottomed out. I don't think earnings are going to get cut materially. There could be some impact of raw material prices, let's say over the next couple of quarters. But if I take a 2 to 3 year view from where we stand today, I think the auto sector earnings are set to rise quite meaningfully. So again, when you just look through sector by sector, financial services, IT, pharma, autos, some of the oil and gas businesses, telecom, I don't find too many weak spots right now. The only concern right now is margin pressures for some of the raw material consumers. But again, if you have pricing power, and most consumer companies do tend to have decent amount of pricing power, it will get passed on. There might be some lead lag of a couple of quarters, but will get passed on, and therefore, earnings will not get impacted over the medium term. So I'm fairly positive that corporate earnings could be quite strong over the next few years.
The next question is on this. The inflation is going up, and the oil prices are, of course, it has cooled off from 130, 135 to 100. What impact it has got on your portfolio in terms of earnings?
Yeah, so some of the we obviously own some consumer discretionary sort of businesses. We own some auto companies. We own Crompton Greaves is one of our large holdings. So there will be margin impacts that we'll face in terms of raw material prices going up, and there will be this, like I mentioned, the lead lag effect between passing on those price hikes. So there will be some impact on some of our portfolio companies, but by and large, again, if you just look through some of the other sectors, let's say financial services or IT services, or even pharma, there's very little direct impact from oil prices. I mean, it doesn't matter for these services businesses. There could be second order effect of demand slowing down eventually as people's disposable incomes take a hit. But I think there's very limited direct impact on our portfolio companies, and we're quite well placed. Where we've, and I'll preempt this question, more recently, some of our portfolios have underperformed the benchmark, is because we don't have too many of the commodity producers in our portfolio. We don't have too many metal companies or oil and gas businesses, or even, let's say, coal India, etc. Those sort of businesses haven't made it into our portfolio yet, and therefore we've lagged the benchmark more recently. But I think, again, this is very short term. Over a period of time, I think we've demonstrated that, we can generate alpha over the benchmark.
What is your outlook on large, mid, small cap as a segment? Can you throw some light on this? What is your outlook on large caps, mid caps, and small caps for next 5 years?
Yeah, I think, again, the valuation chart that I was showing you, this is the Sensex level, right? So which looks slightly at the top end of the price to book band over a period of time. But there is a lot of divergence within companies, within small and mid caps, within large caps. This is just an aggregate number. So I think, rather than focusing on how much mid and small cap do you have, how much large cap exposure do you have, it becomes very stock specific. You need to be very bottom up with your approach. In general, the larger companies so far have benefited from managing, the uncertainty in the environment. Just to give you an example, let's say a larger commodity consumer in the cement business or in the paint business, etc., will have more bargaining power with its suppliers, will have more pricing power with its consumers because they might have a better brand, etc., and therefore can manage this volatility a lot better. Some of the smaller mid caps, you need to be more careful in terms of what the impacts could be. But again, I wouldn't want to call out one specific market cap saying only large caps will do well or only mid caps will do well. It will become very stock specific, and you need to analyze each industry and company bottom up.
Very true, very true. And the next question is, this is a very strange question. HDFC and HDFC Bank are merged into one, and there is a cap of 10%, more than 10% a mutual fund cannot buy. Is it advantage PMS?
Interesting question. Yeah, so technically the PMS doesn't have the 10% limit. So it is an advantage if we believe that the combined entity weight, whatever it will be, let's say 11-12%, I think is what it looks like of the BSE 200. Will we want to be overweighted, then we can do it in the PMS, and the mutual fund will not be able to do it. But I wouldn't be surprised if SEBI and AMFI, etc., make representations and get that 10% threshold shifted upwards. Just given the fact that you can't have a situation where, let's say, a large cap fund which is benchmarked to Nifty, and the Nifty weight of HDFC plus bank is probably going to be 14-15%. You can't have a 10% limit for the fund then, because if that stock does well and they underperform, it's just not possible for them to make up that lost ground. I would imagine there will be some relaxation probably given for the mutual funds as well at some stage.
Since you handled both, I expected this answer. Anyhow, sir, and the next question is, the China plus one, it is becoming a big theme, and along with PLI, and what kind of outlook and what kind of weightage have you given for these China plus one and the PLI into your portfolio?
Yeah, I mean, again, we didn't cover that. That's another big theme that's taking place in India, which is this whole shift of manufacturing supply chains across chemicals, some of the APIs, some of the electronics and the PLI schemes that have come through. This is again a big opportunity over a period of time. We have some representation in our portfolios. We own some chemical companies, some manufacturing companies as well, which are beneficiaries of this. So yeah, I mean, fairly positive on that. It probably requires a separate presentation on its own about the opportunities there. Maybe at some stage we can work with that as well.
In fact, some more questions have come, and in fact, the punity of time is not allowing me to take all those questions. But we will send across these questions to be answered by you, so that the investors will get their answers for their respective questions. I would like to thank Mehul and Paytm customers, along with all the participants. It is a wonderful time we had with you. And in fact, thank you and God bless you. Thanks, Mehul.
Thank you, everyone, and have a great day.
Thank you very much. Bye.